Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by ctmfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host Pushpendra Mehta. Joining me today is Paul Galloway, Senior Director, Advisory Services at Strategic Treasurer. Welcome back, Paul, to another episode of the Open Treasury podcast. We truly appreciate your time and insights as we explore critical topics shaping the landscape of corporate treasury management and beyond.
Always a pleasure, Push.
Thanks so much, Paul. In today's edition, we shall discuss 4 topics, namely human error drives surge in ransomware-related financial claims. JP Morgan has raised the probability of a US and global recession starting before the end of 2024 to 35%. Digital innovation is slowly transforming corporate foreign exchange trading. And finally, oil prices climb because of Middle East escalation concerns. Our audience can watch videos on the CTM File YouTube channel and explore insightful articles, interviews, and industry roundups on ctmfile.com either by visiting the website or by following the links provided in our show notes. Let's commence today's discussion with our first story, which is about human error driving surge in ransomware-related financial claims. In late February, Change Healthcare, one of the largest health payment processing companies in the world, suffered a ransomware attack. Change Healthcare, a subsidiary of United Healthcare Group, accounts for nearly 40% of all medical claims in the US. The cyber attack not only crippled the US healthcare system, but also resulted in theft of 6 TB of medical data and the payment of US $22 million in Bitcoin by United Healthcare Group to a ransomware gang in an attempt to protect patient data. Following the hack of Change Healthcare, ransomware attacks against healthcare organizations spiked, as reported by Wired on June 12th. In April, the healthcare sector experienced 44 attacks, the highest number recorded in a single month by cybersecurity firm Recorded Future in its 4 years of data collection. After a significant drop in 2022, research from Chainalysis reveals that ransomware payments rebounded, surpassing the $1 billion mark in 2023, with median extortion amounts exceeding $1 million in more than 60% of ransom demands and associated fees. The severity of ransomware attacks has increased as criminals have continued to pursue larger ransoms. This assertion is supported by the fact that financial severity of claims related to ransomware attacks in the resilience portfolio surged by 411% from 2022 to 2023, as noted in the Resilience Mid-Year 2024 Cyber Risk Report. For several years, ransomware, business email compromise, and transfer fraud have been at the forefront of the cybercrime landscape. Human error is at the heart of many of this year's most notable and destructive cyber incidents. Given that cyber risk is intrinsically or fundamentally a human-engineered risk, this is not surprising, observes the report. An unpleasant fact is humans are the most likely point of failure in cybersecurity. It's time to point fingers, and yes, you are the problem, says the Resilience Report. Paul, humans as in employees remain the weakest link in cybersecurity, contributing to the spike in the severity of financial losses related to ransomware attack claims. While current and continual cybersecurity training for employees is vital for identifying and reporting cyber threats, do you think a more focused approach like ongoing and specific payment fraud or payment security training for employees is better at detecting and mitigating both familiar and emerging types of cyber attacks before they occur?
Well, Push, no training is going to be bad. So doing nothing is bad. Doing something is necessary. It's a need. You have to do it. You can't ignore it. And when we talk about training, we talk about training across the chain from a treasury perspective. It's how to identify, how to find out what's going on out there in the current industry today, what cyber criminals are doing to try to trick people into doing things that they shouldn't be doing. And the only way you're going to be able to help combat that from a human standpoint is training. And it needs to be ongoing. So it needs to be consistent. So we talk about it in terms of payment security training. And this type of training that's ongoing and facilitated by a firm like ours, Strategic Treasure, we provide those services, I think is essential for corporations today. We give you a tailored approach to payment security training, but it doesn't end just there. So let's say, an organization signs up for something like that and they do this on an annual basis. Is that enough? The answer is no, it's not enough. And the reason it's not enough is because companies are being attacked on a consistent basis. And so whether it's ransomware, business email compromise, social engineering, or some other approach, deepfake, which we had one earlier this year that was quite severe. These types of attacks are going to continue. And so educating your people in between any annual, quarterly training, you have to do it. It's completely necessary. And it's the only way that you're going to be able to keep people up to date on what they're doing out there. And if you get something that comes in, share that with your people immediately. Let them know, hey, here's what they're trying to do. Don't click on this, don't do this, do this. So you have a response plan, especially in the case where by accident perhaps, or just because they're not educated and they didn't know any better, you have an employee that clicked on something and the next thing you know, you've got a ransomware issue or something else that involves a financial loss or potential financial loss to the company. And the best way that you can help mitigate that is training, have a response plan, make sure that you have your plan A, B, and C in place to try to mitigate these challenges that are out there. And people need to recognize that maybe I need to take an extra step to ensure that what's coming through, what I'm seeing or what I'm hearing is legitimate. It's that trust but verify approach. You have to do that. And if you aren't educating your employees on a consistent basis, there's not a good way for them to prevent that type of thing from happening to them because they don't know any better. They haven't been trained. They haven't been taught how to recognize things. There isn't any kind of plan in place. They don't know steps to take to respond to things where, hey, it might be suspect. So making sure that people are educated is paramount. So if corporations have a desire to learn more about this, we certainly have plenty of information on our website, which I think is valuable. Take a look at it. Training, payment security training, you have to do it.
That was a really interesting perspective, Paul. Thank you for shedding light on this crucial topic. I couldn't agree more. I think, and we all know that corporates are under attack and treasurers must respond. With the fraud on the rise, corporate coffers are being targeted by increasingly sophisticated criminals. One of the best ways to protect your organization is to educate your people. Visit securetreasury.com to get specialized payment security training. Next up, let's delve into the second story, which focuses on JP Morgan raising the probability of a US and global recession. After a year of surprisingly strong growth, the US economy is now showing signs of slowing. The July jobs report was softer than expected, with the unemployment rate rising for the fourth straight month, sparking a market sell-off and heightening fears of an impending recession. In light of recent economic developments, JP Morgan Research has raised the probability of a US and global recession starting before the end of 2024 to 35%, up from 25% in its mid-year outlook. Important elements of our growth forecast are being challenged, said Bruce Kasman, chief global economist at JP Morgan. US news hints at a sharper than expected weakening in labor demand and early signs of labor shedding. The latest business surveys also suggest a loss of momentum in global manufacturing and in the euro area, weak links in the expansion that we have expected to lift this year. On the other hand, these forces are being tempered by solid continued gains in overall activity led by the services sector. As Kasman observed, however, the vulnerabilities associated with recession, such as sustained profit margin compression, credit market stress, and energy or financial market shocks, are notably absent. As such, we have only modestly increased our assessment of near-term recession risk to 35%, he added. Paul, last week, the US Federal Reserve or Fed gave a strong signal that the central bank would soon lower interest rates in response to easing inflation and weakening job market. Do you think a 25 basis points or a 0.25% cut in interest rates in September will be nearly enough to avert a recession if JP Morgan's raised probability of a US recession turns out to be true? Or do you think that the Fed ought to cut its benchmark rate by at least 0.5 percentage points to have a fighting chance of avoiding a recession?
Well, Push, there's a lot of things to unpack here. First of all, when we talk about probability of recession, I do think the probability has increased that we're going to face a recession, either 2024 or 2025. The potential for an increase could be there depending on economic indicators and Fed action. So when you think about 35% probability of a recession here in the US and globally, you got to remember there's 65% chance that it doesn't happen at all. So we're still talking about something that's a higher percentage of not happening. Now, take that with a grain of salt though, because 35% chance or 45% when you go into 2025, that's still a very high percentage. And so you want to pay attention to what the Fed's doing, what those economic indicators are saying. And so we have been seeing a little bit of consistency in the economic indicators. We'll see if that continues. Now, what I do believe the Fed action will be is 25 basis points in September. And the reason I believe that is that this Fed is one that's going to take a methodical approach to trying to manage inflation and bring the economy to some level of stability. And now, what we've always seen in the past from the Fed is that sometimes they act too soon or they act too slowly. That question is yet to be answered. I think history is going to tell us. I don't know for sure whether 25 basis points in September is enough, but what I can say is that if they are methodical and it's going to be ongoing, that will be a good thing in the sense that it will help the economy as the economy continues to slow. Now, the other thing that could have an impact on our economy is policy of the newly elected president. We have elections in November. There is a Fed meeting right after the elections. And policy by the newly elected president, whoever that is, could have a direct impact on the economy. Could be stressful, or it could be something that is easing and helps the economy. It depends on who gets in the office. So we've got a couple things that could lead to a higher or lower percentage chance of a recession. Economic indicators, Fed action, new president policy. We don't know. There's a lot of unknown factors. Actually, all those are unknown right now. I do feel there's 100% probability of Fed action in September. They've already said it's time to take action. I do feel it's a higher probability of be 25 basis points. It potentially could be 50. They could come out of the gate strongly, wanting to try to get things controlled sooner than later. So I do put some weight to 50 basis points. I believe I saw an economist out there that was talking about 75 basis points. They feel like the Fed has been too slow and should have acted sooner. I put a really low probability on 75 basis points. I don't see that happening. 25 is most likely. China is experiencing a significant economic slowdown. We're seeing some signs of that with some stock crashes that are occurring within their country. So they're feeling some pain. A global slowdown is definitely something that's on the horizon, and we'll just have to keep looking at economic indicators on a global basis as well, because it could have an impact on the U.S. potentially as well. I think those three other items are the ones that are going to be key to determining or trying to figure out, are we going to have a recession or not? I'm a little bit pessimistic and feel like we probably within the next 12 to 18 months could be in a recessionary phase. The question would be, how significant is it? That I don't know. I think we still have questions to answer. Seeing some consistency in what the economic indicators are doing, understanding the Fed's thought process, and thinking through what the rate decisions might look like, and then knowing who the president is and their policy are going to have a big impact on that.
That's an intriguing take on the subject, Paul. Let's shift the discussion from the probability of recession to the third news story, which is about digital innovation slowly transforming corporate foreign exchange or FX trading. Companies worldwide have an opportunity to save money and reduce risk through a transformation of their FX desks, according to Coalition Greenwich. A highly efficient and effective corporate FX desk or foreign exchange desk can improve a company's liquidity management and currency hedging while also supporting other key objectives of the treasurer. However, many companies continue to view foreign exchange or FX as just an ancillary part of their relationship with their corporate banking partners. Paul, as a former treasurer and an experienced treasury advisor, do you think corporates globally should be increasing their focus and resources devoted to foreign exchange, as well as encourage their FX desks to adopt more advanced tools?
Yeah, Push, I think if treasurers and treasury teams aren't putting more focus on FX now, they should be. I think we've seen the indicators out there that are telling us that ignoring FX and the impacts of FX on your organization, and we're talking about organizations that are not domestic alone. If you're domestic based and all your revenue is generated with local currency, then this isn't something you're going to worry about. But if you're a global or international company that is paying or receiving local currencies across the globe, then you have something you need to pay attention to. We saw recently with some action by the Japanese version of the Fed, BOJ over there. Japan made a decision that had an impact on their currency rate. And for a long time, we had lots of people at lots of banks out there that were engaged in a carry trade. And so it's where you can borrow cheaply in another currency and convert it and turn around and invest those funds in something that's higher yielding. And you get the differential, that's the carry that you get. Well, that recently had flipped on a temporary basis. When I say temporary, I say that in the sense that the carry trade actually completely flipped. So banks out there are no longer engaging in that. So there is impact on FX that you need to pay attention to. So if a currency is strengthening or weakening, that could have an impact on revenues that you repatriate back to your homeland, wherever that might be, wherever the company resides in. In some instances, it may be that you're not going to repatriate because FX rates aren't right, taxes associated with are punitive, and so you have funds that are kind of essentially trapped. So being able to manage the risk of fluctuation in FX rates will help bring better stability to your earnings and your earnings forecasts. So if you're a publicly traded company, a fluctuation in FX could have a big impact. So ignoring it isn't necessarily something you want to do, especially in today's environment, because we are seeing changes in FX rates on a global basis that can really impact your bottom line as an organization. So treasurers need to take steps to utilize technology to help them manage FX. And companies have different approaches to doing it. It may be a combination or a hybrid approach of, accept rate fluctuation in certain currencies, and perhaps in others you are hedging yourself or you're locking up rates or swapping to ensure that your bottom line is not going to be harmed and you're able to manage your cash flow more efficiently.
You've raised some interesting points, Paul. Let's now turn our attention to the fourth story, which is about oil prices climbing more than 2% yesterday after Israel launched a series of preemptive strikes against Hezbollah targets in southern Lebanon, escalating tensions in the Middle East. Given that Russia launched a major missile and drone attack across Ukraine, while Libya's government in Benghazi halted oil production and exports, Paul, do you think rising geopolitical and oil supply risks could disrupt the regional or world's crude oil supplies and drive oil prices up dramatically, thereby impacting the corporate treasury landscape?
Yeah, anytime you have this type of activity in the Middle East, it definitely has an impact on oil prices because you worry about broader conflicts and disruption in oil supply. For countries where disruption in the Middle East has less of an impact, meaning they don't rely so much on the Middle East for oil, that oil prices really won't have that kind of impact directly on them. It would be more indirect. For the United States, we still have a strong reliance on foreign oil today. Even though we have reserves, we are looking for alternative supplies to bring oil into our country. There's still a pretty heavy reliance. So anytime we see any conflicts in the Middle East, you'll tend to see that oil prices will become more volatile. It's sitting at, roughly $80 a barrel today. It's certainly not the highest oil prices I've seen. I've seen over $120 a barrel in the past. And when you look at that, there's several things that impact that. And sometimes it's conflict. Sometimes it's things like a global pandemic, a crash in your economy, like the Great Recession, can have impact on oil prices. And so they can ramp up and they can turn around and fall down quite quickly as well, depending on how those things are being resolved or how things are playing out. With COVID, we had an initial ramp up and then a drop down tied to what demand would be on oil. And if you don't have people going out and about and you're not transporting as much as you used to, then demand on oil dissipates. There's certainly some concerns around the conflict we currently have in the Middle East becoming more prolonged and the potential to broaden. And the fact that we're seeing strikes happening within multiple countries does give some concern to continued increase in oil prices. So we'll just have to keep an eye on what's going on over there. If Israel and Hezbollah come to some kind of a ceasefire agreement, that would certainly help things out. Being preemptive like Israel was, perhaps you might be seeing a counteroffensive from Hezbollah in the near future. Who knows? I don't know for sure, but it wouldn't surprise me. And we could see some increased volatility in the oil prices and push up 80 plus sometime in the near future.
Thank you for the discerning viewpoint, Paul. Finally, Paul, what is your choice for the biggest or most important story of the past week and why?
Yeah, Push, I think the most important story, especially from a treasurer standpoint, that we had was the meeting in Jackson Hole last week by the Fed. The Fed's comments on Friday, I think, were very welcome. At the same time, people are saying, okay, How much is that going to be? What's that impact going to be? Are we heading for a recession? So these things are certainly in the back of people's minds. Treasury teams, treasurers, they're thinking about this, but that was certainly a huge announcement to have the Fed recognize the time has come to start lowering interest rates. That's going to be the most impactful over the next 30 days. That's going to, well, less than that. The Fed meets the 17th, 18th of September. So we've got roughly 3 weeks. We're going to know what the Fed action is going to be, and that's definitely pretty impactful.
Well, we've reached the end of this episode. We are grateful for your informative analysis and precious insights, Paul. Thank you so much. We also want to express our sincere gratitude to our CTM File audience for tuning into this edition of the Open Treasury podcast. Please subscribe to our podcast and check out the show notes for links to the articles discussed. Thank you and have a wonderful week. This podcast is provided for information purposes only, and statements made by CTM File or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.